Here's a puzzle that should bother you more than it does. Somewhere in a bank right now, a computer is pricing a financial contract whose payoff depends on what a stock does over the next year. Nobody knows what the stock will do, not the trader, not the model, not the universe. And yet the computer spits out a number, say 7042, and treats it as the fair price. Not a guess, not a range, a price. So here's the question that's going to drive this whole video. How can pure randomness produce a single defensible number that everyone agrees to trade on? And weirder still, why does the math used to get there pretend the world works in a way it obviously doesn't? The tool that does this is called risk-neutral pricing. The name itself is a confession. It says, to price this thing, we're going to pretend investors don't care about risk, which is absurd. You care about risk. Pension funds care about risk. The whole reason stocks return more than savings accounts is that people demand to be paid for taking risk. So why would anyone build a pricing theory on a premise that's plainly false? And more puzzling, why does it work? Why do prices computed under this fantasy match prices that real risk-hating humans actually trade at? That's the mystery. Let's unwind it. To see the tension clearly, let's strip the problem down. Imagine a stock worth $100 today. In 1 year, exactly two things can happen. It goes up to $120 or down to $90. That's it. A toy world, but it captures the essence. Now I offer you a contract. If the stock ends at $120, I pay you $20. If it ends at $90, I pay you nothing. This is a call option in its simplest form. The question is, what should you pay me today for this contract? Your first instinct is probably to ask, what are the probabilities? Is the up move 50-50, 70-30? Surely the price depends on how likely the good outcome is. Hold that thought because the answer is going to surprise you. Here's the naive approach. Say I think the stock has a 70% chance of going up. Expected payoff is 0.7 times $20 plus 0.3 times $0, which is $14. Discount that for the time value of money, and maybe the option's worth around 13. Done, right? Wrong. Because if you and I disagree about that probability, you think 60%, I think 70%, we'd compute different prices. We could never trade. And yet in real markets, traders with wildly different views about where a stock is heading agree on option prices every second. Something else is going on. The actual probability of the stock going up turns out to be, and brace yourself, completely irrelevant to the option's fair price. To see why, we need one idea: replication. Instead of guessing the option's value, what if we could build it out of things whose prices we already know? Here's the trick. Suppose today I buy some shares of the stock and borrow some cash from the bank. I want to choose those amounts so that no matter what happens next year, up or down, my little portfolio is worth exactly what the option is worth. If I can do that, then my portfolio and the option are the same thing in disguise. They must cost the same today. Otherwise, free money. And markets don't leave free money lying around for long. Let's actually do it. I want a portfolio that pays $20 in the up world and $0 in the down world. If I hold some fraction of a share, call it delta, and borrow some amount B at zero interest for simplicity, then in the up world I have 120 delta minus B, and in the down world 90 delta minus B. Set those equal to $20 and $0. Two equations, two unknowns. Solve. Delta equals 2/3, B equals $60. So, buy 2/3 of a share for about $66.67, borrow $60, net cost today, $6.67. That and only that is the fair price of the option. Not 13s, not $14, $6.67. And nowhere did the probability of going up appear. Now sit with how strange that is. The option's payoff depends entirely on whether the stock goes up. Common sense screams that the probability of going up should matter, but because we can replicate the option using the stock itself, the stock's price today already encodes everything we need. Whatever beliefs about the future are baked into that $100 price, they automatically flow through into the option price. We don't need to know what those beliefs are, we just need the stock to be tradable. This is the deep idea. Replication erases the need for forecasts. But here's where the magic trick happens. Watch closely. Take our answer, 6 is 67, and ask, is there some probability, call it Q, such that if we pretended the stock's expected return was 0 and used Q to compute the option's expected payoff, we'd get 6.67? Let's check. Q times 20 plus 1 minus Q times 0 equals 6.67. Solve. Q equals 1/3. So if we make believe there's a 1/3 chance of going up, the naive expected value formula gives the right answer. This Q is the risk-neutral probability. It's not what anyone believes. It's a synthetic number, manufactured to make the math come out right. And this is the sleight of hand that gave the technique its name. We invent a fake world, a world where everyone is indifferent to risk, where every asset is expected to return the safe interest rate, and in that fake world, prices are just expected payoffs, easy, clean, solvable. We compute the price in the fantasy world, then carry it back to reality. And somehow the real market agrees with us. The question is, why isn't this cheating? Why does a fake probability give a real price? The answer is that the risk-neutral probability isn't really a probability, it's a price in disguise. Look at our number Q equals 1/3, even though we might genuinely believe the up probability is 70%. The gap between them, between 1/3 and 70%, that gap is the market's price of risk. The risk-neutral world quietly bundles together two things: how likely the upstate is and how much investors hate ending up in the downstate. By pretending risk doesn't matter, we're not ignoring risk. We're hiding it inside the probabilities themselves. The numbers look like beliefs, but they're actually prices. Now scale this up. Real stocks don't just go to two places, they wander continuously, jiggling every millisecond. To handle that, mathematicians replace the two branches with a smooth random walk, called geometric Brownian motion. The replication argument gets more elaborate. Instead of buying a fixed fraction of a share, you continuously adjust your holdings as the stock moves. This is called delta hedging. Push the logic all the way through and you get the Black-Scholes equation, a partial differential equation that beneath all its symbols is saying exactly what our toy example said. Price the option as if the world were risk-neutral, discount at the safe rate, don't ask about probabilities, replicate. And this is why the formula works in practice, even though its premise is absurd. It doesn't actually claim the world is risk-neutral. It uses risk neutrality as a computational trick, a change of coordinates that makes a hard problem easy. As long as you can replicate the derivative by trading the underlying asset, the trick is exact, not approximate, exact. This is the quiet equation in the title. The price equals the expected payoff under a fake probability, discounted at the safe rate. 3 lines of math and they tame an entire ocean of randomness. But you should know where it breaks. The whole argument rests on being able to replicate the option by continuously trading the stock. In reality, you can't trade continuously. There are transaction costs. Stocks sometimes jump, gap down on bad news, and you can't hedge a jump you didn't see coming. Volatility itself changes over time. Each of these cracks lets a sliver of real-world risk back in, and that sliver shows up as a discrepancy between the model's price and the market's price. Traders spend their careers obsessing over those discrepancies. The famous Black-Scholes formula is less a law of nature and more a baseline, the price if the world were as nice as the math wants it to be. When the assumptions broke catastrophically in 2008, models that assumed mortgages defaulted independently when they actually defaulted together turned trillions of dollars of supposedly safe bonds into rubble. The math didn't lie. The replication story quietly assumed correlations that the real world refused to honor. Risk-neutral pricing tells the truth only as well as you've described the world you're hedging in. So here's the answer to the question we started with. Risk-neutral pricing turns random noise into a fair price not by predicting the future, but by exploiting a structural fact that derivatives can often be rebuilt from simpler tradable parts. Once you can rebuild a thing, you don't need to know what it's worth. You just need to know what its parts cost. The fake probabilities are a coordinate trick that hides the price of risk inside the math. The deep idea isn't that markets are rational or that investors are indifferent. It's that prices contain information, and if you can replicate one thing using other things, their prices have to lock together. No forecasts required, and there's something almost philosophical here. We tend to think pricing the future requires knowing the future. Risk-neutral pricing says, no, you just need consistency. You need every price to fit together so that no one can build money out of thin air. That single constraint, no free lunches, is strong enough to pin down the value of contracts on things nobody can predict. It's one of the strangest, most beautiful results in applied mathematics, an equation that turns ignorance into a number and gets away with it. Most of the time.